Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we make investing fun, simple, and real. I'm joined by my good friends Noah Davidson, Corey Halliday. Gentlemen, thanks for being here.
Excited to be here.
Speaking about risk management today, got a couple of different techniques we're going to put head to head. Talk a little bit about putting on the stop loss. Also, we have some protective puts, and we're going to talk about kind of dive into detail. I generally keep things pretty big picture, but this is a question that people have asked. We're going to answer it and do a little teaching in detail in this one with protective puts and a stop loss, and which might be better and when you might use one over the other. Make sure you like and subscribe and hit your notification bell so you know when there's new episodes released. And very important, go to your free website, yourinvestingclass.com. We have some resources there that are very important. Financial education begins with understanding how to manipulate your financial statement. When I homeschooled my two boys, 8th grade-ish, we bring them home between 8th and 9th for a year of financial education. One of the very first lessons was understanding how cash flowed through that thing and how to start to manipulate that where you can make it look the way you want it to look. There's 6 numbers on there. There's income, expenses, asset, liabilities, net worth. Net worth is probably the least important of those 6 numbers, but there's a power of 6 there. And when you can learn how to change those and the different ways you can change those, you can really take action and mold your financial statement. It's one of the very first steps you make towards getting out of the rat race or staying further out of the rat race and not getting sucked back into it. So with that, go to yourinvestingclass.com. That's all free. Click it, check it out. My prediction is this. When you do that, you'll start to go through the material and you'll say, wow, this is insight that I did not have before, and I see that this can be life-changing for me. That's my prediction. With that, quick introductions. We'll start with Corey.
Yeah, excited to be here. I got started in the markets 25 years ago, got licensed, worked my way up the ladder, eventually became a Series 4 option principal, which is the head of option trading for a New York-based firm. Did that for a number of years, retired, 15 or so years ago, and now I do education. I love that you did the gap year with your sons where you took them out of school, did 1 full year of financial education, and my prediction is that 1 full year of financial education probably has a bigger impact on their financial futures than any job, anything they could have learned from school for that 1 year and so forth. And so if you dedicate that time just towards learning financial education, how powerful is that? And I try to do the same thing with my kids.
Fantastic. Noah Davidson, ladies and gentlemen.
You know, what seems like many, many years ago and really a separate life, I was a young, hungry guy who wanted to make some money. And I was kind of stuck in a sales job where I didn't see a lot of upside potential. And I had started investing and trading, and I was struggling at it, but then I hit a home run. It was probably because I was lucky. I wasn't good yet. I was lucky, but I hit a home run, and I realized that there was such incredible potential there for me. I decided to become a student of the markets, and it's one of those things when the student is ready, the master appears. I met a person who I decided I wanted to be my mentor, and I hired them to teach me, and that set me down a path where I became a student of the markets. And because the mentor told me straight up, it's like, I can't teach you everything I know because it's taken me 25 years to learn. So if you want to be able to do this, you have to really become a dedicated student.
It's a great question to everyone ask themselves. If I were listening to this podcast, I'd ask myself that. Have I, in my own self-concept, have I hit that point where I become a serious student of investing? Am I toe dipping in this, or is it like this is what we do every day? So I'd say we're pretty serious students of investing. We spend an inordinate amount of our time. Is that a word, inordinate?
Yeah, inordinate. Yeah, it sounds right.
I don't even know what that word means. It seems like a lot, more than average, right?
Yep.
An impressive amount of time. Who's in your circle if you're a serious student? What have you learned if you're a serious student? So that's a great way to start this, and a question to ask yourself. We're going to give a tiny little bit of financial education because, it's 30 years, and that's almost 100 years combined
Yeah.
of studying this stuff. And so we're going to give what we can, but your best move is really, that's where life changes, when a person decides, I'm going to be a serious student of the market. So great. There's 4 pillars to investing. Every asset class, every business, commodity, real estate, stocks, whatever you want to do, financial education can be neatly sorted and organized into 4 areas. You play the cash flow game. That's fundamental analysis. You learn how to read a financial statement. That's the strength of an entity. If I look at a real estate project, there's just certain fundamental things that should be there. Fundamental analysis means we analyze, which means we look at things closely. Fundamental means the most important stuff. For my doctor friends, they do this in a checkup all the time. I always joke that I could walk in there with a freaking bone sticking out of my arm saying, yeah, a little compound fracture. You might want to look at this. They'll go, Andy, just let's get your weight. Like, are you freaking serious? I got a bone here sticking out. Yeah, but we need your BMI, right? There's just certain fundamental things that make a body run right. A1C and cholesterol and all that stuff they care about. The same is true with the business. That's fundamentals. The second pillar of investing is price action. Prices move, whether it's commodity or real estate or rent or option premiums or stock prices or the price of gold or the price of tea in China. Whatever it is, prices move. Markets have sediment. We care about that so we can get really good prices. Those are just information gathering. One is about the entity, the other is about the markets, the buyers and sellers. And they work together in the markets. So it's a very broad swath of information. We can do nothing about it. Third is my favorite pillar. That's the cash flow pillar. That's when I can begin to act. We just did a podcast on the conflict of Iran and Israel, and we had things we could do to position ourselves to profit from what was happening in the world. Good, bad, or ugly, that's our job, to profit. And to put ourselves in the path of cash flow, to increase cash flow based on fundamentals and technicals. But by far, the most important pillar, by far, is risk management. And so when a person is on a continuum of education and they look at where they stand on those 4 ideas, fundamentals, technicals, cash flow, and risk management, that's where you see the room for improvement. That, where do you want to be? Do you want to be aware of these things? Do you want to be able to get an A on the test? If I gave you a test on cash flow techniques, could you get an A? But most importantly is proficiency. Can you actually do it? Can you click a button, get paid? Can you demand money from this world without having to go to a job? Isn't that amazing that we have that power? Like, I don't need to go to a job to go demand money from the world. I can click a mouse and have money come into my account from the market instantly up front. That's a tremendous incentive to become a serious student. But in doing that, there's always a risk attached to reward most of the time. And so having a Series 4 option principle, on our team, Noah and I just geek out with risk management. So the people I'll set up the discussion of stop loss and the discussion of protective put in 2 ways, with 2 metaphors, and I'm going to let you guys fight it out. The people in the Titanic did not perish because the ship sank. They did not perish because they were arrogant and didn't think the boat would sink. They didn't perish because they hit an iceberg. They didn't perish because the water was too cold. They didn't perish because they drowned. They perished because there were insufficient lifeboats. End of story. Yeah. You fix that problem. You don't, like, I've been on many cruises. Cruises aren't my favorite unless it's with the real estate guys. Then it's fun. Yeah. If it's with Robert Helms, you go, right? That guy's a party animal. But other than that, cruises aren't my favorite. But every time I've been on a cruise ship, they have a little muster station, and they count, and you are assigned a lifeboat. Yeah. You make sure there's enough lifeboats for everybody. You don't get on a ship without a way to get off a ship. You don't get into a 401k without a way to get out of one. You don't get into a trade without a getaway. So a stop loss is one form of exit strategy we can talk about. And it essentially is, at what point do you decide to get off of the ship and onto the lifeboat? And what criteria do you establish, and what point do you decide abandon ship?
Yeah.
And that's what the stop loss is the decision to abandon ship, to have that safety, to say, look, I'm not going to drown. I'm not going to hold Enron down to zero. I'm not going to hold WorldCom down to zero. I'm not going to hold General Motors down to zero. You know, all these companies are not doing it.
And one quick point on that, you've probably heard the analogy of Warren Buffett saying, rule number 1, don't lose money.
Yeah.
Rule number 2, don't forget about rule number 1. Whenever you say to someone, don't lose money, they might think, well, that doesn't make any sense. Of course, Warren Buffett has had losing positions, right? They've sold positions that were at a loss. What he's really talking about, and everyone that truly understands the market is talking about, is the difference between don't lose money means don't stay on a sinking ship. There's no reason that you need to be in something that's just going to continue to go down, 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 and lose an inordinate amount of money and waste all that time and see your capital dwindle and have it work your mental, do bad things to your mental state in terms of how you feel and so on. There's just no reason for that. And so the whole idea behind risk management is those rules. Don't lose money. It doesn't mean that you won't take a loss. It means you don't stay on the sinking ship. And this is where I think people that don't understand the 4 pillars, they really don't understand whether the ship is sinking or not.
There you go.
Because
the price doesn't mean the ship is sinking.
Exactly. So you'll hear this all the time. Oh, I haven't lost anything because I haven't sold the stock. It could come back for me. Well, you're not using any analysis to really look at the underlying business or anything. You're a gambler just hoping that you can get back to break even. Right? It's the gambler fallacy of they go in there and they start placing bets and they're losing money and they think, boy, if only I could get back to break even. And this is why gambling is so terrible, is people end up losing their everything all in that hope to get back to break even.
The sunk cost fallacy.
Yeah.
It is literally prospect theory, which was Amos Tversky and Daniel Kahneman who came up with this idea that people are naturally risk averse.
Unless they've lost something.
And then they've lost something, and now they're down.
Then they'll bet the
Then
farm.
all of a sudden, people who are normally risk averse become risk seekers, and they double down, and they buy. They buy more.
Yeah.
They start saying that a trader became an investor.
We've conducted these experiments in Houston ourselves. So we'll talk about stop losses and get into those weeds. Then the other option is you could say, well, you have insurance. I didn't lose my money because my house burned down. I lost my money because I didn't have insurance.
Yep.
And the insanity of not having either is not up for debate, even though you have a 401k with neither.
Yeah.
I mean, think about this. You when you sign up for a 401k, there is no line in the sand, no predetermined exit plan. When you get on that cruise ship, they say, here's what the alarm sounds like, here's where you go, here's what you do, here are the instructions beforehand, and when we know exactly what it looks like, exactly what to do, and it would save lives. There is no exit strategy in a 401k at all. I mean, that thing can just disintegrate and, okay, I guess I'll stand here and we'll play, abide with me as the thing goes down. Isn't that what they played on the Titanic? What they play, the fiddler?
Something like that.
Nearer, my God, to thee.
Is that whatever? No, was it?
In the movie.
Well, I don't know. I didn't see the movie.
It wasn't there in the real.
Let me tell you, I tried to watch the Titanic movie with DiCaprio or whoever he is, and I got to tell you, everyone was talk about expectations setting up disappointment. Everyone's like, "Oh, this," and I'm sitting there like, "How long does it take this thing to go down?" Didn't this thing should be sunk by now? My gosh.
It's a big ship. It takes a long time to go down.
I got to tell you, that was a painful deal to watch right there. I mean, that was borderline chick flick.
Oh, it's for sure chick
I have
flick.
that in my prenup. No chick flicks for me. Yeah. We don't want to get in that. My wife my wife and I get along pretty well, but I think one of the maddest she ever got at me is she wanted to watch this movie with McConaughey. Talk about a guy that can't take a punch. Like, I don't watch guys that can't take a punch.
All right.
Yeah, exactly. But McConaughey, I shouldn't. He's a good guy. I'm joking. I'm trying to be a chauvinist here, I guess. But there was a how to lose your guy in a day or 10 day or whatever it was, and Marcy says, "Let's watch this," and it was awesome because she fell asleep. She fell asleep in the movie, so I turned on Sports Center. Yeah. She woke up, and I'm watching. She woke up, I'm watching Sports Center. It was really nice. It was fun.
Funny.
I says, "Okay, we flipped it back." She fell asleep again, twice. Same movie.
And you're just trying not to move at all, so she doesn't wake up.
Yeah, and I'm
again.
not even curious about how it ended at all. Sorry, Matthew. Stick with what was he good in?
Well,
that same movie, 10 different ways, same cast.
Is it Dazed and Confused? Is that what
I
it is?
haven't watched
He's
it.
great in a lot
I don't
of
watch
shows.
it.
I actually like the guy.
Titanic.
Yeah. Oh,
so
yeah.
you're going to sit there while they're playing the fiddle while the ship sinks? You don't do that in your 401k. Oh, you're going to have insurance. You're going to have a house with no insurance. People have wealth in their homes, equity in their homes, and they have equity in their 401ks. That's where they hold some of the money or the wealth that they have. They insure the heck out of their houses, right?
Yeah.
And no jokes about California. I used to joke about that, but the last one was too big, so now I can't joke about it. But really, what's more likely to burn down in your lifetime, your home or your 401k?
Yeah.
And there's a serious threat to the 401k. So the idea of protected put versus stop loss, I'll tell you how Mark Cuban did it. He went with put.
Yeah.
He actually did a collar. So I'll tell you a little story. Mark Cuban did a lot of. I like Cuban, by the way. See, I'll bet he could take a punch. You know,
He's got a punchable face.
You can take a punch. Actually, Zuckerberg,
I'm just kidding, Mark. It's great.
Zuckerberg can take a punch.
Yeah,
he's
got
a black belt in
MMA.
jiu-jitsu.
He's doing some MMA
He's
training.
working out.
I still want to see the Zuckerberg versus Elon that was supposed to take place. I think I'd put my money on Zuckerberg on that one.
If Brazilian
training.
jiu-jitsu, he went in with a Rogan was talking about this. He went in with a mask from the COVID, and I actually think he won. I don't know. I think my weight class. I'm not a black belt in Brazilian jiu-jitsu. Can I hold on with Zuck? I don't know. I mean, if he's that good, I don't know. I can beat him in an arm wrestle, though.
You could beat Elon.
I don't know. Elon, who knows if it'd really be Elon, right? Elon's got his little cyborg going in there. But anyway, Cuban, bartender, started a tech company, and he was pretty smart in how he started his tech company. He had an idea, and he gave people equity. Come work with me, build a vision. You get better people. That's a great way to start a company, is just equity. And so all these guys become millionaires on paper because he sells broadcast.com to Yahoo. And this is in the 90s when it's all big. And year 2000 or so, right around before the bust, he sells Yahoo, or he sells Broadcom for $5.7 billion in stock. And he had over $1 billion of that personally held. Well, they had a 6-month vesting period where he couldn't sell it, so a stop loss was out of the question for him. So he took all the money that he had and he bought puts. He bought protected put options, which expired worthless. And I was given that speech once in a live situation, and some moron raised his hand. He says, "Well, Mark Cuban must not be very smart if he spent millions on insurance and all those puts expired worthless." And I want to say, well, he also owns the Dallas Mavericks, so he must not be too stupid. He's made a couple good deals, moron. Isn't that funny how a guy with no freaking money would criticize him for having insurance? And I wanted to say I was nice, but I wanted to say to the guy, did you buy insurance on your car this month? Moron. Did you buy insurance on your home this month, moron? If not, you're a moron, because you insure things that are valuable. And if you got $5.7 billion in stock, you better insure some of that, right? So the 6 month goes by, and he did a collar trade. And this is interesting. I'm going to guess it was around $100. So let's say he makes a promise to buy at 105 and use that money to insure himself at 100, right? Something like that.
Yeah.
Or at 95 or whatever. So he did a collar trade, which is essentially a protected put that the market pays for. So we know that Cuban, at that point, preferred you're either going to get paid to sell it a little higher, with that, or you buy insurance, and he went the insurance route rather than the stop loss route.
And that ended up saving him I don't remember
making him.
He
said he was
$1 billion
overinsured.
or something.
Yeah, on the 60 Minutes interview he did, he said I was covered and then some. So to me, that tells me he
bought even more puts than he
had
had.
Some, not just
shares.
Protective puts, but maybe some opportunistic,
speculating.
Puts. But,
and again, for context, this is .com era, Yahoo boom time.
Yeah.
Right before the bust, and Yahoo
it made him
was
look like
busted.
a genius.
Yeah, absolutely.
Yeah, and maybe he was. I mean, maybe.
Well, he's a trader. I followed him on Twitter, and he's a trader. He knows what he's doing.
The collar trade caps his gain, but if you just did a pure protected put, here's your one thing about a protected put is you preserve upside.
Yeah.
So if you're if the thing goes through the roof, Kambamba,
But the collar's brilliant in that I think his outlook was he was willing to take an exit. That once he was past his vesting period, he said, well, look, if I get called out on the call side, even better. But if the stock goes down, I want that protection so that I get to exit at its current up here at these strike price levels, not at the fall, the price that it fell to. And had he not bought that protection, he could have still sold all of his stock, but now it would be at a considerably lower price, right? And so the difference, and that's really what protective puts give you, is they lock in your sell price. So even though the stock spirals below that, you still get out at that higher price if that happens. And it's similar to like in car insurance. If your car gets totaled, your insurance company essentially is buying the car at the prior value, right? Same type of concept with a protective put.
By the way.
Yeah.
They came and picked up the car at the junkyard.
Yeah.
Because it was totaled.
They can sell it for a few parts. But in essence, they're paying you the value that it was at before the crash.
The problem is that car won't repair itself, and the market often will.
And the stock can. So, and this is where we love it, is what if, so imagine the stock's at 100 and I buy protection and the stock tanks. And then I sell my protection and put all that big profit in my pocket. And then like a transformer, the stock repairs itself, right? So a car can't do that, right? But a stock can. How does it repair itself? It goes back up in price over time. Yeah, but I can capitalize on that drop.
And the company was really never damaged. The price only was.
Exactly.
The company was really never damaged. When we come back from break, I might even throw another wrench in this and throw another trade out there for you guys to talk about. But we're talking about the difference between a stop loss. When we come back, we'll define stop loss. We'll define protective put more clearly. We'll talk more about when you might do which one, where. And I might even throw out another trade that is defensive and let you guys argue about that when we come back.
Responsive to questions, they're very detailed in their training. You can start from no investing experience whatsoever and get educated and be able to make a nice retirement for yourself or even a living. It's an amazing educational system, and I would highly recommend it. The one thing that will get you more confident in investing is your education, your competency, and if you can get to that point, you can do anything.
Welcome back to the Cashflow Academy podcast. I'm your host, Andy Tanner. This is where we're going to do our best to make it fun and really try to make it simple. That'll be the big one. And, of course, what we talk about is real. And Noah Davidson in-house, Corey Halliday here in-house. And we're talking about protective puts. So let's define this protective. So it's a defensive move out of the gate. Robert had a book, Robert Kiyosaki, called The Unfair Advantage. And he called us down to Phoenix. Blair Singer, Kenny McElroy, Tom Wheelwright, Garrett Sutton, Josh and Lisa Lannon, myself. I think those were the advisors at the time. And then some other people close to the Risk Dad organization. He says, I'm writing a book. We used to love this because when he'd have an idea for a book, we'd talk about it. And we'd kind of not be involved, but we'd get a chance to watch his process as he'd write The Unfair Advantage. And he said, I want all of the advisors to actually take part in this. And he asked me to write about this. And he asked me a question. He goes, what's the difference between an amateur and a pro? And I said, amateurs often seek profit through capital gain and manage risk through diversification. Pros seek profit through cash flow strategies and manage risk by contract or insurance. And I said, I think that would be the biggest differences I see when I see the behavior of amateurs and pros. So a protective put is a contract of protection where rather than buying the farm and hoping the winners outnumber losers, rather than buying the whole market and diversifying, hoping winners are more numerous than losers are or more profitable, we actually buy insurance policies on a particular position over a period of time where we might see it is at greater risk. And that gives us a guarantee. If the defining characteristic of the market is unpredictability and the inability to choose when you can buy and sell something, the market's just going to go where it was, the options market reintroduces those options or those choices to buy where you want to buy or sell when you want to sell for a small fee. And you can buy insurance or sureness in an unsure world. That's what insurance is. It gives you sureness where you're sure about something in the midst of unsureness. So a protective put definition, options principle.
Yeah, it's actually why the options market was created in the first place. They said there's a stock market, there's all this value tied up, and people wanted the ability to be able to protect those investments. And so they created puts and calls. And calls can protect a short stock position, puts can protect a long stock position. And so, like you described, a protective put is basically me paying a small premium, a small percentage, maybe 1%, maybe 2% of the stock value for protection against downside risks. And what can happen and what does often happen is that 1 or 2% that we paid grows to become 5 or 6 or 7 or 8% in a big market meltdown, in a stock that's falling sharply lower. And so we have two choices at that point. We can still sell our stock at the higher agreed to price, or we can just capitalize on that downturn and sell our protective put back to the market. But in essence, it is protection. It's the same way you buy car insurance, you buy house insurance. You are paying money, a premium, to buy insurance on a stock that you own.
There's good and bad to this because this creates a context of education once a person decides this. If they say, oh my gosh, I did not know I could insure this type of investment, well, that's wonderful, but it's not like buying car insurance because it creates a void. It creates a space of it creates a lot of problems for me. Because now I need to know what a strike price is. I need to know what expiration is. I need to know what strike, what expiration. I need to know delta, gamma, theta, rho, all these different. There's a lot that comes into play, and it's really an education move more than a tactical move, more than anything else. It's the moment someone comes to me and say, like, they'll when the market falls, all three of us have this happen, and this happens. It really happened when Trump threatened tariffs and we had that 9% drop in a day. Your phone blows up and all of a sudden people want to know how to insure things. And the message I give them is, well, that's fine, but this isn't, you can't put your seatbelt on in the middle of the wreck.
Yeah. You
got to learn what that seatbelt is long before them and develop those habits long before them. And I had a lady ask, we had a mutual friend. And he texts me. He says, Andy, I know you're a busy guy. I have this friend. Can she call you? She's got some questions. I'm like, sure. Any friend of yours, friend of mine. She calls. I didn't spend a lot of time, significant time, maybe 45 minutes on the phone. And the first thing I said to her is I said, there's a decision to be made whether you either learn this or don't. And, it's a lot like the Karate Kid. If we do this, we're going to do this all the way.
Yeah.
It's like in the Shawshank Redemption where who's the rock and roller kid that comes in that steals the TV?
Oh, yeah, and then...
What's his name?
No, it's the young kid that he teaches.
What's his name in that thing?
I can't remember, but he teaches him and he gets his high school diploma and so on.
But he says, look, he goes in and he's kind of like, I've been thinking about working on my high school equivalency. And, Andy Dufresne says, listen, we go all the way, nothing half-assed.
Yeah.
We either do this or don't. And that's the way I talked to her. I said, look, if you want to learn this, you can't just go to like, could I just do the first year of the med school and then go do the surgery? Do I really have to do all 4 years of the med school? Or do I really have to do all the law school and pass the bar? How about I just watch a couple of freaking YouTube videos on this, right?
Oh, yeah.
And so
that's
when
my wife and I's current running joke. I watched a YouTube video on it.
like
I'm an expert.
And I stayed at Holiday Inn last night, right? And so I told her, because I could see it coming. And so she told me all the problems she'd have of losing, all of which a stop loss or a protected put would have solved.
Yeah.
Either one would have solved her problems. And she lost way more money than she should have lost. I mean, I was very polite to her, but inside I'm like, how you stand there and watch a financial advisor destroy your retirement like this and charge you to do it.
Yeah.
And charge you to do it.
And then,
Well, to finish the story,
go ahead.
at the end, I said, this is education. This is the things you learn. She's like, oh. And she saw it as a burden rather than an opportunity. And she says, well, is there any way I could just is there a middle ground? And I wanted to go back, and I wish I'd recorded the conversation, because I started like, look, going down this road, you're either excited about it or you're not. And if you're not excited about learning, if learning is a burden, this is not your podcast. It's just not.
Yeah.
And I wouldn't have an interest in, as a teacher, I would never teach in the school system. I spent some time there as an assistant basketball coach in the school system. I would never want to hang out there because not all of the kids want to be there. And the truancy, to me, I'd say, look, kid, if you don't want to be here, go do whatever you want. You don't have to be here. But the fact they're forced to be there because they think it's a bad thing, they're not fun to teach. So whether you want to learn the protective put or the stop loss, you don't. This isn't like a stock tip where, I know protective put now. There's years that you put in to learn to do these well.
Yeah, and I think people end up, like, to your story's point, that people pay for this one way or another.
Oh,
right?
she paid way more than she should have.
Right, and so the education idea is you're paying for it by not knowing and dabbling in the markets. You're going to make mistakes that are going to be costly. You're going to do things that fall into just the obvious pitfalls that can be avoidable, but you're going to have to figure that out and go down that road. Or you're paying for it by all the missed opportunities. Like you talked about the cash flow idea and how I can access the markets on a monthly basis and I can generate cash flow, or I can go buy protection in times of turmoil and have complete insurance and sleep like a baby at night, not worried one bit about what the markets are doing. People pay for these things in one way or another. And so the idea behind it is, well, I can go the simple route, and this is kind of what I teach my kids, is there's a simple route and there's a more difficult route, and everybody has to choose. And I would prefer to go down the simple route, but I can't force you to do anything, and it's solely up to you. You get to decide which of these two paths you want to go down. One is a little easier, a little simpler, it's a little more prosperous. Sometimes they just want to go down the other road.
Well, yeah, I'll tell
like.
you what, you learn. So I told you at the beginning about wanting to learn and hitting a home run.
Yeah.
What I didn't tell you about was what happened prior to that. I got a hot stock tip, and this thing was going to go through the moon, to the moon.
Oh, you think we landed on the moon?
Oh, yeah, I know, right? This thing's going to the moon. So I buy some. I buy a lot because I want to get rich quick. And the stock, immediately, it's almost like it knew I bought.
Noah's in.
Yeah.
It stopped.
Noah's in.
It turned around. Much to my horror, that stock went down. A lot. And in a panic, I called a guy like Andy who knew what he was doing. And I said, well, what do I do? And he said, well, where did you put your stop loss? And I said, my what? He said, your stop loss. I'm like, my what? I don't know what you're talking about. He goes, the order you could put in place to sell when the stock price goes below your risk threshold.
It's such
I'm like, you can do that?
You should,
And
Google comes out at 85 a share. Google comes out at 85 a share. And people are trying to decide whether to buy or not. A stop loss is probably the best way if you're going to mess with the IPO game. it might be the best, easiest way to do it. So, okay, I'll buy at 85. If it goes to 80, I'll sell and I'll risk $5. But if it goes up, I have unlimited upside. So when you put a stop loss in, your risk goes from 85 to 5.
Yeah.
That's basically what it's a line in the sand. Now, Buffett wouldn't do it that way because Buffett is a fundamental guy. He would not let a price dictate the exit. But there would be nothing wrong with that on an IPO if you thought, hey, this company could really roll somewhere, but I'm risk adverse. I really can't stomach it going to 40 before it goes up. Okay, buy it. Now at least you defined a couple of things: your entry, your target, and your exit. And you would have a risk reward ratio between what your target and exit would be. So to define those, a put is a contract that you pay for that gives you the right but not the obligation to sell the stock at a certain price, no matter how far down it goes. That's Cuban. A stop loss is where you say, I'm buying at this price on this tip or whatever, and I'm going to sell at this price, and that means no matter what, this is how much I will lose, and that's it. And if it goes to the moon, great, it goes to the moon, and you have upside and downside. Of course, as you go down in education, then you get in the mentor club with Noah, and he says, well, look, if you buy the stock at 85 and you're going to sell at 80, that's a $5 loss. So buy the stock at 85, and if you see a technical move, sell the call in the money where you get the $5 of intrinsic value and get paid to sell at 80 instead of just selling at 80. Because if you just sell at 80, you lose 5. But if you sell the call that pays you to sell, which you want to do anyway, well, why not do, why not sell the in-the-money call and get paid that $5 of intrinsic value to do that? And then if it goes up, well, you can deal with that, other ways. But your technical move where you have that trifecta of stock, then you'd have call, and then you'd have put in that order.
Well, and that's to kind of finish that story off. I ended up hiring that guy to be my mentor because what I ended up doing was I looked at the expense of how much.
Is it Jeff?
It was Jeff.
I thought.
So I looked at how much I had lost, and he says, "Well, I'm not going to teach you for free," so I had to pay him a little chunk of money, but it was the best money I ever spent because in that process I learned not only how to think about the risk. I learned 7 different ways to control and mitigate the risk, from starting with position size. Of course, you can always use a stop loss. You can buy the protected put. You can sell the covered call. You can do the call, or you can do a ratio. I mean, there's a lot of different things that you can do to offset the downside risk, knowing what to do and when to do it before you open the position, before
planning a trade and then trading the plan.
Yeah, and that's the big difference. The people that just kind of dabble in the markets and they turn on CNBC and Jim Cramer touts a stock and they jump in. Well, they have not considered risk management
or
one
4
bit.
pillars.
Right. They have not looked at the fundamentals, the balance sheet of the company. They haven't even looked at a chart. It's just blindness.
All I heard was buy.
Lazy.
But the problem with that, I mean, that's a real telltale sign as to whether somebody really is going to be successful or not. It's just the first question you could ask is, well, how are you going to manage risk? If you don't know how to position size so that you're not risking too much, if you don't know how to use a stop loss or a protective put, you're not a serious investor that's really going to be able to capitalize on the markets long term. Because here's the sad truth. The markets are built to create problems for people that don't know how to manage risk.
Oh, say that again.
Yeah, the market
that
is
should be
built,
a short right there.
Yeah, the market really is built to create problems for those that don't know how to manage risk. And the reason for that is, what do people do? Well, if it works, they take a small profit and they pat themselves on the back and they go, "Oh, I'm a genius. I made $5 a share." And then if it doesn't work and it's going, they just sit and they hope and they pray.
Because it hurts to hit that sell button.
Have you ever gotten to the point where you actually have to build a sacrificial altar in your backyard and then go out and try to appease the market gods with burnt offerings? I mean,
and then here's the worst part of that.
My gosh.
Here's the worst part of that, though, is that as the
I
stock
wonder
tumbles,
what that smoke coming out of your backyard was. I thought it was a barbecue.
Burnt offerings, barbecue. It's a
To
very
your point,
fine line
yeah.
between those
Continue,
two.
Corey.
but listen, the worst part of that is as that stock tumbles and they keep hoping and praying for it to come back, and they've built the altar, it doesn't come back until the point where the market has found their breaking point, right? And it's just too much pain. It's the old no mas, can't take the pain anymore. They dump the stocks probably on horrible news that the company this or the market that, and they just give up and they say the market's rigged, it's out to get me. It has nothing to do with that. It's all about your risk management. You cannot profit in this business taking tiny profits and massive losers. You'll end up with a huge hit rate. You might have a 90% success rate. You make profits, but they're tiny on 90%. And you take some massive losses on 10% and you will lose a lot of money.
Yeah, I had a fun conversation one day with a market maker, a really bright guy named Dan. And we were talking about stop loss placement. And I've had this conversation 1,000 times with people. It's like, it feels like every time I place a stop loss, the market maker hunts me down and takes me out.
You're trading 100 shares like anyone cares.
Yeah, exactly.
Right?
And so I was having this conversation with the market maker. I said, what would you say to that person so that they don't get out of the habit of using a stop loss? And he says, well, the first thing I would say is nobody cares about you. You got between the market maker and a piece of meat. And so I was like, well, he's like, there was a large order down there that needed to be filled, and your stop loss was placed in a wrong place. And so if you can learn how probabilities, market dynamics works, you can do better placement of stop loss. But and then he said your first line of defense is position size, your second line of defense is stop loss or option.
Yeah, but the idea that they're going to move Apple $100 billion in market cap to go get your 100 shares, give me a break.
Right.
But
that's how people feel.
It is. I mean, in that moment, you feel like the market's out to get you.
I'm a victim.
How do you think I became a conspiracy theorist?
No, this really answers a lot about Noah.
Right.
The sacrificing in the backyard, you know, what scares me is he said he offered burnt offerings. I want to know what actually was killed.
Okay, so I burned the chicken. Anyway,
You used to have ducks.
I was going to say, you used to have a duck.
Yeah.
And all of a sudden one day the duck is gone. We thought it was a coyote or something, but now we know where the duck went. What in the heck? Poor little duckling.
Poor little Howard. Howard the
duck. Gee whiz. There's a lot of wisdom in what you said in terms of the market being built to extract money from those who A, are uneducated, and also B, is temperament.
Yeah.
In the book by Benjamin Graham, it's a great read. I try to read it once a year. I don't often encore read, but this is worth the reading. Is The Intelligent Investor by Benjamin Graham. And it's not really about intel, like there's a couple of examples of value formulas, but it's really a lot about containing emotions. And, I break this rule once in a while. I broke it during COVID. He says, keep your trading and your investing separate.
Yeah.
It's okay to speculate and it's okay to invest, but first of all, don't commingle those ideas. And second, know when you're doing one and when you're doing the other.
Yep.
And don't, because a lot of people think they're investing when they're speculating, and they don't know the difference.
You don't want to trade your investments, and you don't want to invest in your
sins
trades.
here. In COVID, it worked out. Maybe I was just lucky. I talk a lot about Prudential, Dow, Exxon, some of the stuff we picked up in COVID. The biggest position I picked up in COVID was Exxon. And I'd had that stock before, but we wanted to add to what we had. And not knowing we were going to have a pandemic, I really liked it at 55 technically, because there was tremendous support at 55. That's stock's been as high as 70. I really liked 55. So I sold puts to buy at 55. So let's say I bring in, 60 cents, $1, whatever it was. I don't remember what it was. So I sell some puts. So that lowers my cost basis by, whatever it was, 60 cents, $1, whatever it was. And once it got close to that strike, I thought, cool, I'm going to get this put to me. I'm going to get paid to buy it. That was the goal, is to buy at 55. That's the investor in me. The investor says that. Well, once I bought it, I was put in that situation of, okay, do I trade the price and put in a stop loss, right? And as an investor, I said, I don't care if 55 works. And here's why 55 works. And I kind of went and did a little trading too, though. The reason 55 worked, is think about this. I didn't need a stop loss on that because I had another way to get my money. If we pulled down the cash flow jack in the box off the shelf there, and we look at a cash flow jack in the box, the idea is don't lose money.
Yep.
And how you get to that rule doesn't matter. Just don't lose money. Well, if I can see a dividend at 87 cents per quarter then, and I see a stock that has increased that dividend for 40 years straight, I know that I can get some of that money back, that $55 back through a dividend. So now, and so I look in the year, 5 years later, I says, well, that'll be $1 per quarter if they raise it just a penny a year or whatever it is. Now it's close to $1. It's like $3.96 a year. So $4, how long does it take to get to $55? So it takes, a little over 12 years or whatever it is, just dividend. That's too long. But if all of a sudden you start writing calls on that as well, now you're looking at, maybe you can get that money back in 5 years. So I'm saying, how do I not lose money? I pull the money out of the asset to pay for itself.
Yep.
Which is different than a protective put and different than a stop loss, because now I'm looking at the business as my protection, not stock price movement. So at $55 a share, I think, okay, maybe within 6 years the whole thing pays for itself. 5 years, 4 years, whatever options I can write, whatever increases in dividend I'll see. I look at the strength of the business as opposed to the strength of the price.
Yeah.
Now, that said, I see it hit 55, and I think to myself, now we're in COVID, this could go a little further. Do I sell these shares quickly and then try to buy it even lower? How do I get a lower cost basis? Well, so I says, I'll buy a put. So I bought puts at the same price I sold them at. So I sold the puts to acquire at 55. I bought puts for the right to sell at 55. Well, I think those puts were probably around, they were pretty expensive. I want to say they were around maybe $4 or $5 at the time. But I sold them, I think, for 15 or something like that. Yeah. So anyway, all told, my cost basis, so then the stock goes down, and then I sell the puts.
You reduced your cost basis.
I keep my stock,
there. Yeah.
And that's the key. That's why I like I keep the asset, so the investor wins because I keep the asset.
Yep.
But now my cost basis on, I think I figured out, is like 43. So now if you're getting, if you buy it at $40 a share, and now the dividend's at $4 a year, you're roughly, I'm probably 9%, 10%-ish.
Yep.
Dividend-wise, you write covered calls now at 109 or whatever it is. It's probably down. Who knows what it is? I haven't looked at it. I haven't even looked at that stock since the Israeli. I have no idea where it is. Don't know. Don't care, because my cost basis is so low that it really doesn't matter. And now the thing gets paid for. If you're doing 20, let's say you do 18, 20% a year, because you've got 10% off your, you got 10% going off your dividend. You're writing covered calls up top, and think of the strikes you're writing at when your cost basis is 44, 43, and you're writing strikes at 112 when it's 100 and whatever. Those are big paydays.
This is what I love about the financial markets is you think about, you can do the same thing in real estate or something else. You can put a renter in there and they'll eventually pay off the house and you can still keep collecting rent. But with houses, I've got to continue to do repairs. I've got to do upkeep. I've got to put more money in. Your money in that stock is done.
Yeah,
it's finished. And yet it will pay itself off, and then it can pay itself off again and again.
For generations.
And you can keep, and you can pass that on to your kids and your grandkids, and it's such a simpler process. I don't have to find a renter. I don't have to do this or that. It's, hey, I need to go find some strike prices, understand how to manage my risk, collect that premium, continue on that path of just generating that income, and the opportunities are endless.
The comparisons between real estate and stock in this situation are awesome.
Yeah.
Let's break it down. Okay.
Yeah.
You find
Which
the
I
asset.
love both,
you find
by
the
the way.
asset,
Yeah.
right?
Yeah.
They're both
Okay.
great.
You buy it. Maybe it pays a dividend, so you got some income generating off of it. You learn the skill how to write a good covered call. You generate cash flow and income. So but you own the asset, and then you need to, from time to time, make sure you have insurance. So if you own the house, you're going to buy insurance. You're going to have a renter, right? And if there's something damaged on the house, you've got the insurance to cover it. In the meantime, the renter's cash flowing. Sometimes when you buy or sell an option around your investment, you wind up with an income. Sometimes you wind up with a little expense. So like the AC goes out in our rental unit, and now we've got a business expense that it's something you have to, but you've covered that because of the rent you have coming in, and so on and so forth, and you continually get that cost base down until, like you say, you get to a point of infinite return. The people don't really think about stocks that way. Like we started this conversation.
They could.
What's funny
They
about this?
should.
We started this conversation about stop loss versus put options, and it's evolved into, well, as an investor,
Yeah.
Well, but
As
but
an
here's-
investor,
but
we
here's
don't
the
have
other
to have
reason.
either one.
right?
Yeah.
But the other reason is the reason you like the put and the caller is if I were to start worrying about the price of Exxon now and locking in that gain, I don't think about it that way at all. But if
Yeah.
I did, I say, okay, I've got a new line stand. I've made all this money. I want to give it back. That's not my mentality at all. Like
Yep.
I'm not worried about giving it back. I just don't want the goose to die. And the stop loss would trigger an insane capital gain for me right now. So that's off the table right there. But a caller trade is really nice because I could sell the call to pay for my put. And that's really nice for neutralization. That even as an investor, if I worry about my net worth falling too hard or a big systemic problem, great. I don't want to give up the dividend. If you sell the stock, your dividend's gone.
Yep.
I'm not giving that dividend up at that cost basis. Are you out of your mind? There's no freaking way. But a caller trade allows you to maintain that dividend, put an asset on the thing where there's no up, there's no down. You just kind of sit there and you can ride out a conflict of tariff talk or ride out a rough time if the war, if Israel and Iran escalates. You can batten down the hatches and have some peace of mind, kick your feet up if you want to just neutralize the investments for a while, but keep getting money from the work that's being done via dividend. It's no different than the distribution you get in a syndication. It's profits distributed to shareholders.
That's how I look at it. Is stop losses for me are something that's a trading risk management.
That's separating the
Exactly.
speculative from the investing.
Yeah, if I was trading a stock and I was just trying to capitalize on a price move, I'd put in a stop loss.
All right, now I'm going to up the ante. You ready for this? What about putting a stop loss on my put option that I bought to protect my asset?
Oh, there you go. Down the rabbit
You can
hole
do
we
that
go.
too.
You
But-
not only can, but
yeah.
you should.
Yeah, absolutely.
So stop losses more just stock trades, protective puts more of an investment.
I think
strategy.
so. Yeah, very much a fan of Mark Cuban for that example there. Well, fantastic. We've got the blue screen of death on our monitor here. That means our time is up. I thank Noah. I thank Corey so much for your friendship, your mentorship, and all you give to the Cashflow Academy community. Learn either way, whether you want to protect yourself with cash flow, protect yourself with a protective put, or a stop loss, time and a place for all of them. How do you know? Continue to get educated. If you don't have proficiency in those trades, keep on learning and keep on working. We'll see you next time.